Hello everyone. Today we are going to talk about why I bought UnitedHealth Group stock and the reasoning behind it. In institutional investing, some of the best opportunities arises when a company's fundamental earning power is temporarily obscured by high-profile, non-recurrent volatility. In 2025, UnitedHealth Group faced what can only be described as a black swan event. We saw a massive drawdown in the share price, falling nearly 60% from its peak to bottom. This was driven by a series of chaotic events, a crippling cyber attack, and the tragic loss of CEO Brian Thompson, and also a major DOJ antitrust probe and a significant downward revision in the earning guidance. While the broader market panicked, I view this as a dislocation of value. UNH is essentially the infrastructure of the American healthcare system. My thesis is based on the fact that while the headlines are negative, the data empire and the vertical integration of this company have never been more defensible. So back to basic, if you ask me how this specific stock got into my attention, I usually run daily or weekly scan around the markets that I trade and look for stocks that have been down around 25 to 30% from its 52-week high. Along with, there are some fundamental scans that I run. I need at least decent volume. There are some other metrics. This is not the exact match of what I used for UNH scan, but usually I look for decent sized companies with at least 200 mil market cap. I need optionable stocks so that I can sell cash secured puts at the start and then enter at a price which is comfortable for me. If I don't get those stocks assigned, I'm still fine. I'll collect the premium and then happy with that. Usually I look for companies with at least 25% gross margin. If your gross margin is not around this range, it's really difficult to get some net margins or other cash flows at later operations. I also do a volume analysis to check what price range people are buying. For example, when the price drops, usually there's a consolidation period. So I do a volume profile analysis to check where most of the buying actually happened. You can see in this period, most of the buying happened, of course, around $300 mark. That's why I started buying around that range. You can see that these very compressed price around 240, no volume happened, which is an indication that nobody is selling at those prices, or most of the consent is around $300 mark. If you go back on time, you will find that there are some heavy trading that happened around 480 mark, and this period around again 300 mark. So if you buy the stock around 300 mark, my decision point at that point was that I'm still at a safe margin. Of course, since the price recovered to around $300 after this major drop, there was another drop around 20%, right? So that's why you need to manage your risk when you're putting these trades. If you bought it around 250 mark, we are talking about going back to around 2020 price ranges. Looking into the charts alone won't help you to make the decision. You can see the UnitedHealth had a decent revenue growth. Most of this revenue growth came by adding new members to their plans. They onboarded different states and suburbs into their plans. So they got a decent revenue hike. Along with that, they had a decent increase in their earning per share. But what happened was it started dropping because there was more claims by the patients, but should not be a problem for me, because at the point in time I bought it, the dividend yield was around more than 3%. I also do some checks on the health of the company. There were some severe warnings here, and those severe warnings that it highlighted was not so severe, because the gross margin was declining. Of course, that's a known one. And I knew why it was declining. And of course, it's just a matter of increasing their premium, so they can easily recover from that drop in the gross margins. In addition to that, I usually do some valuation. So looking into UnitedHealth stock, you can see their normal PE over this period is around 21, right? So let's say 22% to make it easy for us to understand and learn this. So at that point in time when I brought it, let's zoom it out, let's say about 10 years, you can see the PE ratio around 230 was around 11x, right? So at the time that I started buying it, I think it's about 14x. So what I was expecting is that it will normalize into its normal PE moving forward. That was one decision point. Usually when the PE expands, you can see a decent increase in the price. So if you go into forecasting, right? So right now we are at this range around $332. What I'm expecting is, even if it continues the current PE of roughly around 20, by end of 2026, I would expect this share to be around 540. 2027, which I plan to keep for multiple years, you are still getting about 36% annualized return, right? So not bad. Let's say it's worst case, like it's around 16 to 17x PE, which is very unlikely for a stock like this. But let's assume that it really didn't recover. Even in that case, I'm expecting about 25% annualized return with a PE of around 16. Now, I tend to use adjusted operating earnings because this company went through so many changes. You just need to use adjusted operating earnings. I also do like to do some checks with free cash flow for equity. Even at those rates, right? So the normal fair value is around 20. Let's say they use cash for XYZ, right? So they still keep it, let's say around 14x or maybe 16x. You can see that still you are getting around, after 2 years, roughly around 30% year-on-year return. I also like to check whether the company is well covered for their dividends. So you can see their dividends are well covered with the free cash flow that they are generating. So one of the things I like to check, especially for dividend paying companies who's going through a distress period like this, is to check whether their dividends are well covered with free cash flow. So you can see they have a lot of cash coming in because it's an insurance business, of course, and the dividends are well covered. Right? So if there's any contingency, maybe there's a lawsuit and they get a fine, they can still pay those fines and still cover the dividends. So that's the beauty of this company. The cash generation mechanisms is unparalleled. So if you go to operating adjusted earnings, for a long time, UnitedHealth traded well above its fair value. So whenever I'm buying a stock, I always make sure that I'm buying below its fair value based on my valuation. So this was an opportunity that arose for me to make that trade. So those who purchase it at these stages, at this valuation, of course, if you bought it somewhere around here, you had a good ride, but you don't know when these events will happen. Companies always in long term return to its fair value. So when this FOMO is lost, the price dropped, And these are the price ranges, usually just below this orange price, that you should be looking to buy these companies, which I did. Hopefully this will make a good profit in the future. If you like this kind of videos, remember to subscribe to the channel and thumbs up. See you next time.